We saw the high beta, low beta ratio break out above this resistance that it had featured for almost, a year and a half. And now we're obviously, in no man, not no man's land, because it can go much higher from here relative to the dot-com bubble. And by the way, I feel uncomfortable putting this stuff in print and tweeting this, but think about the 6 cycles that matter to financial markets. It's growth, inflation, policy, or monetary policy, fiscal policy, liquidity, and positioning. Growth, U-shaped economy, that means it's going to be better a year from now. Inflation, highly likely to peak within a year. And most importantly, the Fed, on a monetary policy framework standpoint, is amending its reaction function to inflation in a way that makes the inflation risk, it mitigates that risk. So, and we know monetary policy is getting incrementally supportive. We know fiscal policy will get incrementally supportive starting early next year. So that's essentially 3 of those 4 cycles are explicitly positive. One is so positive that it's overwhelming the negativity from the inflation cycle in terms of monetary policy. So obviously that all augurs well for liquidity. When those 4 cycles are doing on a net basis, doing good things for the economy and asset markets, liquidity is going to go up. Liquidity is basically the residual of how those 4 cycles interplay with each other. And so we know liquidity is moving in the right direction on a 1-year forward basis. And so the only thing left that can really topple the markets is the positioning cycle, which is admittedly as full as it was back in February. But again, there's no real threat. In order for positioning and valuation are not catalysts. They are accelerants when there is a catalyst. And the point I'm making is that the 5 cycles that matter that would ultimately cause a significant reversal in the momentum and dispersion of asset classes from a positioning cycle standpoint, they're all moving in the right direction. So to me, I think about where the market could be a year from now. Why wouldn't the market bubble? We should wind up in a bubble. This should bubble. Why aren't we going, we're at 20 something times earnings in S&P? Why aren't we going to 30? We should go to 30. This is secular transition to AI and a huge productivity boom. Obviously it's not gonna be great for society at the end of it, but again, this is labor versus capital. Capital's winning. The stock market is not a market of labor, it's a market of capital. And so that's my general take on this. It's when you see this kind of activity in the internals of the market, which one of the best investors of all time, Stanley Druckenmiller, told us that this is the best economist in the world. The best economists in the world, the internals of the stock market, are telling you that something is getting very good at an accelerating rate. So the defensive ratio, broke out to a new high as well, corrected and bottomed at the previous high. That is as textbook bullish as you get. I'm not even a technical analyst. I don't know anything about technical analysis. But I tell you right now, actually, I do know something about technical analysis. I know that this is bullish.
If only. That's the name of the fucking show.
Only up, only up.
So getting back into this value to growth ratio, chart makes me sad, as is the small cap, mid cap ratio. But the fact that we're starting to bottom here in the small cap, mid cap ratio now, or neutral VAMS signal, maybe that's an early indication that we're starting to broaden out from an AI adoption perspective. This might just be another one of those head fakes. But I do believe that from a sectoral composition standpoint, it is highly likely we broaden out just purely on the fact over the next 12 to 18 months, just purely based on the fact that the economy is going to get better. And if the economy gets better, you're going to broaden out. And so if that's just on the cyclical side of things. On the secular side of things, if AI is increasingly what we are all starting to be, the humanists in us are starting to be concerned that it might be, then you're going to see broadening out as a function of that, because ultimately every company in the world is highly incentivized to implement AI successfully as fast as it can. Otherwise, it's going to get competed out of business, period. So that is what we're facing here. But that's not bearish. It's incredibly bullish for the stock market, incredibly bearish for humans, incredibly bullish for the stock market. The stock market will increasingly diverge from the plight of the common man over the next few years.